Hey friends, so I just bought a stock that is yielding almost 10%. It's BTI, British American. I want to talk about that in the video today. I added to my position. I've owned this one for a very long time. I have to tell you, putting money in something that yields that much, it's really exciting because you just see that cash flow right away. I actually bought a lot of Altria in late 2023. I'll link to that video in the pinned comment below. That purchase ended up working really well for me because I've seen some capital appreciation, but more than that, I have seen some cash flow come through, that almost 10% yield on that one as well, that has just been really almost life-altering, changing for me because it's a lot of cash flow coming through all of the sudden, and it means all the difference to me as someone in his 40s, and I like to travel more now, I like to enjoy life more. I'm at a point in my life where the cash flow is meaningful. And what I want to share today is the topic of the flow of dividends, the flow of money in a dividend stock portfolio. Because many of you know ppcian from the OG Thug Life days. I'm being reminded of that now. I started out as a dividend investor, really putting most of my money in sin stocks. Because I did that, it generated so much cash flow that I then used that cash flow to diversify into these quote unquote higher quality positions like Johnson & Johnson, for example, which is actually a stock I bought last week. I share my trades over on my Patreon. I will link to that in the pinned comment below. So I bought BTI last week and Johnson & Johnson. So kind of a tale of two different types of stocks. But if you've been following me in the recent years, my flow of money, it's been pretty simple. I have capital to deploy, and then I just put it in a buy and hold forever stock like Johnson & Johnson. But recently, I've been reminded that there's a different way to play this game. And this is why I love dividend stock investing, because all of us, we all play the game, we all approach the game different ways. And I approach the game different ways within the same portfolio because I like to diversify, I like to have different strategies working at the same time, and my needs as an investor change over the years. Right now, my need is for more cash flow because I'm at that stage in life. I'm just excited about living life and enjoying life. And so I was reminded there's actually a 3-tier flow of money. Step 1, step 2, step 3. Again, in the recent years, you've seen me go from step 1 to step 3. I have capital to deploy, and I just put it in that buy and hold forever stock like Johnson & Johnson. Or another one for me is SBUX, which was the topic of my last video, which I will also link to in the pinned comment below. But I've been reminded recently, like, hey, there's actually a 3-step flow of money that makes a lot of sense, all the sense in the world for me as a dividend investor right now, especially when I see something like BTI trading at a 9.5% yield and a PE in the 6s. And the flow goes something like this. Step 1, I have capital to deploy. Step 2, I put it in a higher yielding stock, an annuity-like stock, if you will, because these higher yielders, we have to be realistic about them. The equity value is not going to appreciate hugely going forward. Now, I think that BTI will actually retain its equity value, but in the United States market, at least, their management team is saying, they're even telling investors, I'll get to this later in the video, that it should be viewed like an annuity. They see their US Combustibles division basically going to zero over the next 30 years. And so they said, hey, treat it like an annuity. And that's one of the reasons the stock is down so much, is investors were really frazzled when they saw this information being presented. Anyway, the 3-step flow of money for kind of an option too as a dividend investor is to take that capital, put it in the higher yielder, that annuity-like stock like BTI or Altria, and then use the dividends from step 2 to fund step 3, which are those forever investments like SCHD. And that's how I got started way back in the day. I kind of went away from that strategy, but now I'm coming back to that strategy because the flow can get a little more complex than I'm showing on the whiteboard here. What I actually plan on doing is taking the capital to deploy, putting it in BTI, and then taking cash flow from BTI to pay bills and to travel and to enjoy life, but also taking a partition, a segment of that cash flow to put into these kind of final destination investments like SCHD. Honestly, the reason I've been thinking about this recently is I have a tranche of Treasury note coming mature very soon. I had earmarked that Treasury note for SCHD. Ian, put it in SCHD, do the right thing, put it in the quality. But I have Thug Life, Ian, kind of also thinking, oh man, life is short. It is time to enjoy life. Just get that cash flow going. Don't worry what others think. Don't worry how people perceive you as a dividend investor. Do what you have in your heart. And what my heart tells me now is, hey, SCHD, that can wait. My almost 10% yield in BTI, it cannot wait. I will probably take that maturing tranche of Treasury note, put it into a step 2 investment, which is BTI, and then I'll let the dividends come out of that, and I'll use it to fund step 3 investments like SCHD or Johnson & Johnson, others, and living expenses, of course, travel expenses, all of that good stuff. And so what I wanted to share today, there are different ways to handle dividend investing. And I know in the comments over the years, many of you have actually indicated to me that you look at things this way as well. And so put in the comments below, do you look at kind of capital to deploy going into a higher yielder, which then funds other investments? Or do you just put it in the final destination investments? Or do you do a bit of both like I do? I primarily just put capital in kind of those high quality final destination investments, but sometimes no. In fact, a lot of the time when I got started in the early days, I did not. And right now I'm not doing that as well. Now, keep in mind that step 2 investments, I don't sell them. I'm not going to sell my shares in BTI. I'm not going to sell my shares in Altria. It's just a different type of investment. It's an investment that has a higher risk profile. It's an investment that is viewed by society as kind of less than. It's an investment that sometimes you talk about it out there and it's a little embarrassing, but I'm kind of beyond all of that. It's just worked for me as an investor. And I will get into the fundamentals of BTI as well that give me some comfort on their ability to continue to pay that dividend, maybe increase the dividend, and be a really good kind of step 2 investment that just fuels the rest of the portfolio. Of course, I'm not abandoning my core strategy or anything like that, but I have many strategies at play in the portfolio all the time that I'm always evaluating. And of course, there's pros and cons. Option 1, which is the flow from step 1 to step 3, it's lower risk. It's sleep well at night. Option 2, which is flowing from step 1 to something a little riskier like a step 2 into the step 3, it carries more risk, but the benefit of it is fire comes quicker. And the cash flow, it's instantaneous, it's overnight. And so with that, I want to share on the screen right now with all of you the purchase I made last week, which just shows you where BTI is at right now. It's trading when I bought it at $30.12. Now it's at $31. It's down from the 52-week high. Part of that is because of this announcement that they're basically writing off the U.S. business over the next 30 years. They see it, the combustibles business, declining in value in volume over the next 30 years, and they took a non-cash charge on that in late 2023. I'm going to get to that in a minute, but that's why it's down. People were spooked by that. And I think it spooked Altria investors as well, but Altria stock's actually trending up, so go figure. Anyway, the forward PE based on analyst estimates, and this is an adjusted number that does not take into account non-cash write-offs, depreciation, for example, amortization. It comes in the 6s now. So this really got me excited that, hey, I'm basically buying this business as if it's going out of business. And that's why I'm calling it an annuity. Many are viewing it as if it's going out of business. But I disagree. I'll share some more slides in a minute. The starting yield on my purchase last week is a 9.86%. And they're growing the dividend pretty slowly, but about 2% per year. Now, as of this week, because the stock has gone up just a little bit, the starting yield, it's not 9.86 anymore. It is about 9.5%, but hey, that will work for me. What I want to do at this time is I want to get to a few slides about this company, because many of you are at home thinking, hey, Ian, I understand this. I understand what you're saying, but boy, that BTI is risky. And I want to share from my personal standpoint only. I'm only sharing my personal journey here on YouTube. This is certainly not investment advice. I'm not a licensed investment advisor. I'm just sharing, though, the slides with all of you and some of the analysis that gave me some comfort in adding to this position that I've already held for a very long time. And so worth noting, by the way, when I get dividends from these SIN stocks, I take them out. I'm not really reinvesting in these. I'm using those dividends, like I said, to buy kind of these stage 3 stocks, which would be like a SCHD or J&J or a Starbucks, or just to pay bills. And eventually, because they yield so much, I basically get all the capital back out of BTI, not taking taxes into account, in about 10 years, which is great. But I want to share a few slides. So as you can see on the screen in front of you right now, that first slide is just about them revising their acquired US brands value and their useful life estimates. And this is why the stock sold off so much. They're basically saying that they're doing a 30-year straight line combustible amortization for their combustibles in the US. They're seeing that business shrinking to nothing over the next 30 years. Now, of course, it has no impact right away on earnings, dividends, anything like that. But they're saying, hey, after the next 30 years, this is... this business will be no more. And in fact, they're taking a non-cash impairment charge. So what does this mean? When you purchase a company, and they purchased a lot of US companies, they bought Reynolds, they bought Lorillard. Reynolds is actually a stock I used to own. It was one of my best performing investments that I had, one of my earlier investments that I made. When they bought these, they bought them for above their book value, as most companies are purchased above their book value. When that happens on their balance sheet, they have a asset of goodwill, an intangible asset of that delta. Basically, what they're saying is they're carrying that asset value on the balance sheet too heavily, too high. It's not worth what they paid for it. And so they're taking that. They took a write down on the balance sheet. You'll see this in a minute. And also this affects their GAAP earnings that they report. But again, this is a non-cash impairment charge. Their free cash flow, it's actually growing quite substantially. And so this is something that spooked a lot of investors, but I'm personally not so spooked by it. But let's keep going. As you can see on the screen in front of you right now, the next slide that I want to show is the balance sheet. The most important thing to see just at the top is the intangible assets. This is in millions of pounds. This is a UK company, so this is reported in the British pound sterling, and you can see that intangible assets went way down from 129 billion to 95.56 billion pounds. And that's what I'm talking about from the last slide. Right there, that was the write-off in value on the balance sheet. Their assets took a haircut. That goodwill is gone. They are saying that these assets are not worth what they paid for it anymore. And again, this spooked investors. But let's keep going. As you can see on the next screen in front of you right now, I want to share with you their earnings. And so this is their income statement. And you can see here that... their revenue has been pretty flat, 2021 through 2023. But what I really want to show you here is depreciation, amortization, and impairment costs. They have had some depreciation, amortization, and impairment costs roughly of, say, 1 to 1.3 billion pounds per year. But all of a sudden, in 2023, they took a ginormous 28.6 billion pound impairment charge. And again, this is a non-cash thing, but it makes the earnings, the EPS, look just terrible. And it spooks a lot of investors. And I think investors are also just spooked at, hey, this combustible business, they're saying from what they're seeing, it's going out of style. It's going out of business in the US. But when I take a deeper look into the slides, I'm reassured. I have not so much fear as the broader investment community. And that's what I want to share you next. As you can see on the screen in front of you right now, the next slide is just talking about free cash flow. Well, let's look at this. In the same year where they took this really high, heavy impairment charge, their free cash flow, according to the company, was the best yet. It was the best yet out of the last 5 years. It was a staggering 8.4 billion pounds. And you can see, what are they doing with their free cash flow? They're rewarding shareholders with dividends. They're rewarding shareholders, well, in 2022 with a share buyback, and in 2023 with a huge deleverage. Looks like they're deleveraging their debt, which I think is important because we're in a higher interest rate environment. You can see right here in front of you, the business is growing from a financial standpoint. Yes, they took an impairment charge, and maybe what they're saying is over the next few decades, the business could shrink. Hence, I call this a step to annuity style investment. But I think this annuity is going to be really long play out. I think it may be quite a bit more than 30 years, and certainly more than 30 years in context of the broader organization, because the annuity aspect of this investment really seems to be the US combustibles, not the broader picture, which I'm going to get to in the next few slides. So as you can see on the screen in front of you right now, the next one I want to share is just the adjusted results demonstrate continued delivery. Here they're adjusting. This is important. When they adjust out the depreciation, the impairment charge, because this is a non-cash charge, you can see the adjusted diluted EPS, it's up. It's up 4% year over year. It's up an average of 6.1%, 2019 through 2023. And so this is what I want to share. This is a company that is growing. It is growing in size, at least as of now, but it's trading at a PE in the 6s. That's what I love about this. And so sometimes I even question myself, is this a step 2 stock or is this really a step 3 stock that's just on deep discount? Is this a terrible company? Is it really going out of business? Or does the broader society just kind of want it to go out of business because they hate it so much? But it's not. It's just sometimes just because people want something to happen doesn't mean it's going to happen. The company, based on the fundamentals that I'm seeing, it's doing just fine right now. But it always seems to be on that tipping point. And I think that's what investors are arguing, kind of like the Starbucks argument. I think Starbucks will continue to grow and thrive. But everyone is saying, hey, it reached an inflection point. It's now all over. And I think it's always kind of on that inflection point. Every year I've ever owned BTI, but so far it's doing just fine according to the numbers. And as you can see on the next screen, this one's really exciting. They have new category revenue, and they have different types of new categories. They have heated products, vapor products, oral, modern oral products. Their strong new category revenue is great. They're saying 2019 through 2023, they're seeing a compound annual growth rate of 28%. And looking at 2022 versus 2023, they're saying organic revenue growth, 21% for the new categories. And so they have new categories which are growing, which hopefully will overcome some of these traditional categories, at least in the US, that are going out of style over the next 30 years. But it gets better, as you can see on the next screen in front of you right now. They also share, and by the way, all these slides I'm sharing come from their investor deck. This comes just from their investor relations website. I love to dig into this stuff. They're transforming rapidly. They're saying 16.5% of their business now is smokeless, and smokeless revenue is growing. Basically 30% is what it's saying. So this is just fabulous. It's a company in transition. And what I am seeing out of these slides is a very different picture than I think the naysayers want society to believe. And it's interesting. So many people hate these sin stocks. That's why I think they trade at a perpetual low value. It's not only that they're an annuity-like business. It's not only that they're a business that's going out of style. It's not, I mean, obviously Wall Street's smart and they're kind of pricing it according to risk, but it's more than that. A lot of mutual funds, they can't buy these types of companies because they're viewed as sin stocks. These socially conscious investors, they can't really buy this kind of thing. And so that puts it kind of at a lingering discount, if you will, out there in the stock market, a perpetual discount, which is something I also like about these kind of investments. So anyways, just a different spin on things today that I wanted to share with the community, because there are a lot of strategies out there. There's not one right strategy. I have many strategies at play in the portfolio, and this is one of the strategies from my early days that I'm revisiting because I'm seeing value. And when I see BTI, I didn't show it today, but just look at the stock chart. It is abysmal. It catches my attention, and I revisit that strategy from my early days, and I'm revisiting it even more because I'm kind of overlaying my personal age and my cash flow needs for what I want to accomplish in my life right now with my investing strategy. All right, everyone, if you enjoyed the video today, don't forget to click the like button. It means the world to me. And if you've been an OG subscriber since those early days, always love to see you in the comments, but I love to see all of you in the comments. Thank you so much for watching. Before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my personal journey here on YouTube for fun and entertainment. And it's possible to lose money in the stock market. And also, I want to share with all of you today a full disclosure. I own the stocks mentioned today. I'm long British American, ticker BTI. I'm long Altria, ticker MO. I'm long the ETF, SCHD. I want to have it be one of my largest positions, but Thug Life Ian just says, hey, let's wait a little longer. We'll keep that as a goal, but it might take a little longer. Also, I'm long StarBucks, ticker SBUX, and I'm long J&J, ticker Johnson & Johnson, ticker J&J. I love you all. I'll see you in the next video, and I'll see you in the comments below.